Hello, everyone. This is Jeff Wright with Fish Creek Capital, an investment management firm that focuses on dividend growth and dividend growing stocks. I'm looking up at my screen here, did a video last week. I was working on tools, the best tools that are online that you can use. Some of them are free, where you can evaluate companies and figure out what to pay for things. And so, when we look at companies, price really matters to us. And so, I had showed you fastgraphs.com last week, but didn't really get into it as well as I should have. So I wanted to come back and just emphasize this time that price really does matter, and you can use fast graphs as a tool to determine price and a good price that you're paying. Just real quickly, some of the benefits. This is a Claude AI summary of the AI benefits of fast graphs, and I would agree. I would agree with this list. It gives you good visual analysis. It's very time efficient. It saves you a ton of time when it comes to looking at data that's consolidated, that puts all the relevant information right in front of you. It does have a fundamental focus, which is what we like to focus on at Fish Creek Capital. It does not do technical analysis. If you're into that, it does focus just on really fundamental analysis, which we like. Valuation, it really gives you clarity. These pictures with the graphs are great. We like that because pictures worth 1,000 words, and you can easily tell a good evaluation number. It's great for forecasting. They've got a lot of forecasting tools. I don't know if I'll be able to get into that today, but that's something that's there and really good. There's an analyst scorecard that you can use. It shows historical predictions and things, and those always come in handy when you're just evaluating a stock or a company as a good investment or not. You can do back testing. There's dynamic analysis, and I will kind of show you that. You can change the year and how far you're going back and those sorts of things. Tons of metrics that you can look at. So it's really good. Don't really want to make this video too long. I think shorter is better. So let's go back to the SPY again, as far as looking at price matters, to the dynamic feature that you can that I listed as a benefit. This is how you change the timeline up here. We've got it on max. Like, you can go down to 10 years. Like, so that takes us back to well, before it'd be 10 years from now, so 2015 or so. Even then, you can see we're coming in, like on this black line, or on the other video, I talked about what these lines mean. And so on the last 10 years, you can see that right now, we've got a blended PE, or a price to earnings ratio, of 21.89. The average here is 21.51 for the previous 10 years. So we're just now coming into an inline price evaluation. Let's real quickly, if you do 5 years, we're coming in to kind of an average normal price range. The fair value is still going to be down here at 15, so we're not anywhere near that. So as we're having this stock market volatility, the market's really been overpriced, and that's been one of the major problems. The tariffs are making it move around, but really the S&P has been way overpriced, and that shows up if we back out in this chart very, very easily. Like, you can see, just even in January, we were up here at a 25 PE, which is way, way high. Like, so you can click, and then if you take it back over here to the normal PE ratio and click at the blue line on this is going out like 2 years, you can see that your average return, total average return, even with dividends, is like 4%. So, like, if you would have bought all in January 17th, brand new investor, and we're just going to try to ride out future returns, you're on track for like an underperformance at that 25 PE. So let's back it out now, and now that we've had this kind of drawdown, let's look at where we are. Well, there we go. Let's go back to when we were down at the lowest on April 4th with some of the tariff talk. So we got down to a 20.8 PE. So that's a good drop from that other date. So let's use this same blue line with the normal price to earnings ratio. And look at that. Now our return, it goes from 4% all the way up to 11.67% annualized. So that just proves that price does matter. Like it really matters what you pay for things. And this is a great tool to kind of show that, and you can easily see it. Well, that's a great place to stop. Again, this is a great tool. We love using it. It is perfect for valuating companies and putting a price on them. It really does matter what you pay. If you've got any other questions, it's a great topic. Please message me below. And thank you for watching. This is Jeff at Fish Creek Capital.